and welcome to this special coverage of RBI's monetary policy. I'm Ekta Batra and with me is Ananth. Well, it seems as though we're not going full guns blazing on the upside for the RBI's credit policy. In fact, the Nifty is currently showing a 100-point cut and the mid-cap index is also at the day's lower, 1.5% lower, and the Bank Nifty is currently lower by over 2%. The yield, however, stagnant at currently 7.73, very close to its closing level that we saw in yesterday's trading session. Anuj, the entire global picture with the Nikkei down 4% is not inspiring any sort of confidence at this point. RBI policy will just be a momentary flash in the pan on the green side maybe, or maybe just an upside from the lows?
Morning, Ekta. Two things. First, keep watching out for the bond yields today, the G-Sec yields. I think that will be an important indicator for the near-term trend of this market. Ekta, for me, one thing is very simple. This is a near-term bear market. And just like in bull markets, bad news are good news. In near-term bear markets, good news are bad news. So what happens? The market has priced in a 25 basis point rate cut. If indeed there's a 25 basis point rate cut, there's a good chance that then again, after a bit of a pop, then you follow the global cues and you fall again. That would be, it's now about how much fodder is there for the bears. If there is a 50 basis point rate cut, which is an outside chance, but a chance nonetheless, and because of that there's a pop, that for sure would be a sign for the bears to have sort of double fodder and go out hammer and tong on this market. If there's no rate cut, the market would be initially disappointed, but that would put a bit of a floor for the market because that would mean that the hope of a rate cut would still be there in the next policy. So that's how things are stacked up. The Nifty is now trading below 7,700. In the morning, I said that the fact that we did not have too much of a gap down was actually the best possible start for the bears, because with the kind of global scenario that you're looking at, this market can easily fall another 100-point intraday on the Nifty from here as well. For me, the most important cue now is not policy, European market opening at 1:30 p.m. because that's when the market is normally reacting now of late. Yesterday we saw a brutal fall in European markets. Today will be important. Is there follow-up or not? If the European market stabilize, our market will stabilize a bit. If there's further round of sell-off in European markets, regardless of what RBI does, our market will follow that.
Okay, well, right now the European market is not possibly going to be very inspiring, just focusing on what Asia is doing or based on what Asia is doing. But let's get talking to our guests with regards to credit policy. Taimur Baig, Chief Economist, Asia Global Markets Research, Deutsche Bank AG joins in. Ananth Narayan, Head Financial Markets at Stanchart joins in as well. We also have Mr. Kannan, the MD of State Bank of India. So it's a full house. Morning, gentlemen. Mr. Kannan, I'll come to you. What is your expectation from the RBI policy this time, and if in case there is a rate cut, do we see lending rates come down?
I do see a maximum of 25 basis points, though there's an outside chance of a 50 basis point. But I think the consensus overall is 25 basis point. Right now, we'll have to look at our cost of funds, and then if there is a possibility, that will be something which will be passed on to the customer. But 25 basis points is what I'm looking at.
Okay, 25 basis point rate cut. Ananth, morning, the bond market has been relatively stable. In terms of the kind of signals that it's giving you, if you could tell us what's your prognosis, and do you think a 25 basis point rate cut is given?
Morning, Anuj. The bond market is factoring in a 25 basis point rate cut. It's also prepared for slightly hawkish kind of undertone to the governor's statement subsequently from past experience. It will, though, parse the language that the governor uses very, very closely to see, for instance, the word accommodative is still there. Is how data dependent is it? Are they actually reducing the inflation forecast for Jan 2016 and so on and so forth? The other big thing for the bond market, which the market doesn't seem to be talking about too much, is the market is looking for clarity on the policy and the framework for FPI limits on government bonds. As you know, that limit is kind of exhausted right now. And in the last policy, the governor in the subsequent interview had indicated that they're looking at that policy very closely. Any indication that that limit might be opened up will be a huge positive both for rupee as well as for the bond markets. And I think that's something the bond market is waiting for.
Okay. Ananth, just to follow up with regards to the FPIs and G-Secs, what is your expectation in terms of what the RBI could announce? Would it just be a blanket $5 billion, maybe a staggered form, or maybe converting it to possibly a floating rupee as opposed to a fixed rate?
There are multiple possibilities, Ekta. I think currently the holding of foreigners in government debt is about 3.6% of the gross notional. You could have a calibrated way of actually bringing it up to, let's say, 5% over a year or so, which is still a very, very conservative number. That alone could mean, over $10 billion of limits being opened up over time. So there are various ways in which this can be done. In the past, we've talked about recalibrating the dollar-rupee rate for the existing limit, etc. Anything which indicates an opening up of limits, in the next few weeks and months, even if it is a small number of $3 to $5 billion, will be a good positive for the bond markets.
Okay, let's go to our economists as well. Sajjid, Chinoy and Taimur Baig are with us. Good morning to both of you. Taimur, I'll come to you first. What's your in-house prognosis? And after today, assuming this 25 basis point rate cut, do you think that would be the last of the rate cuts for this year, or do you think there'll be maybe room for 1 or 2 more rate cuts?
No, one and done. I think that's the sort of message we will probably hear from the RBI, focusing on not just the issue of the global uncertainty, but also uncertainty about forecasting inflation in India. 3 months ago, we didn't see such steep type of disinflation, but also, the commodity developments are overstating the true extent of inflationary pressure in India. Once you take that away, look at service sector inflation, look at a variety of other indicators of prices, they're not that subdued. And I don't think the RBI can only talk about its inflation target as far as January 2015 is concerned. It has to look beyond that. And once you start thinking about 5-ish as a target for Jan 2017, it doesn't look like a slam dunk, very easy to guide the market toward significantly lower rates sort of a scenario. So unless we have in the coming months and quarters very poor growth numbers, I think the RBI could be just sitting pretty on the 7% repo rate for a long, long time.
Okay, well, Sajjid, actually, I just wanted to come to you with regards to your expectations. I'm sure the street is working with a 25 basis points, but what is the chance of an extreme, which would be 1, maybe a 50 basis points, and 2, a hold? What are your arguments for or against that?
So, our base case is for a 25 basis point cut. I think it's a close call, particularly given that you've had a second successive drought. I'd be very surprised by a 50 basis point cut, because I think this regime at the RBI would have been more aggressive early in the rate cut cycle. We saw some rate cuts out of policy. I think as the rate cutting cycle matures, it would be unlikely to expect dramatic cuts now for the very reasons that Taimur mentioned. I think a number of base effects and this massive global disinflationary tailwind in a way are overstating the degree of disinflation. I think when the dust settles and January comes about, we're looking at inflation somewhere in the 5–5.5% handle, despite all of the favorable global developments and very weak pricing power at home. So if you then have to disinflate the economy to 4% over the next 2 years, it suggests that you don't have too much monetary room, which is why I'd be surprised if we get a 50 basis point cut. You cannot rule out no action today, but I just think that given the downside surprises in July, given the fact that core prices have abated meaningfully in the last 3 months, and the momentum of core inflation has come down because producers faced with these sharp input price decreases are not under pressure to raise final prices, will give the RBI some comfort. And now with the Fed move being pushed out to December, if there is a belief that you need to cut by 25 basis points, this is the opportune window. You do it now before any Fed rate hike in December. So we stick to our call that we get a 25 basis point cut, but I think the guidance here could be cautious that we should be expecting a cycle of cuts going forward. Okay,
Mr. Kannan, the economy is stuck in a bit of a chicken and egg scenario. The RBI is not cutting rates because it wants to see transmission, and banks are not cutting rates. We saw HDFC Bank cut rate, but no big bank followed that. How long do you think this kind of scenario will exist?
See, under the overall market interest rates start coming down, it's very difficult for everyone to, the bankers only to follow suit what the Reserve Bank of India is doing. Reserve Bank of India's repo cut is only a very small portion of the borrowings by the bankers. And I don't understand how actually you can think that anything which is being done by the Reserve Bank of India should straight away be passed on to the consumers. As regards the depositors, once you see the inflation being continues to be high, though it has come off, then the expectation from the depositors are going to be a decent interest rates. And that being the scenario, the cut in borrowing rates for the borrowers will be a bit difficult task unless there's a huge change in the overall market interest rates. And the bond market also, which normally is an indicator of the fall in interest rates, is also only pricing at 25 basis cut. And I think even if the 25 basis cut does take place, the movement in the bond market will not be much. And we still continue to have the government-sponsored deposit rates still ruling pretty high. Though that's not a very big amount, but it also plays on the mindset of the depositors. I think we need to see a lot of action in all the places before we see a huge reduction in borrowing rates.
Okay. Ananth, if in case there is a 25 basis points rate cut that comes through, but the tone is more hawkish and there is no movement on the G-Secs, anything announced with regards to FPI limits, where do you expect the yield to go? It's currently at 7.73.
If the tone is hawkish and if there is no light at the end of the FPI tunnel, bonds will sell off. I would expect yields to go up by at least 10 basis points. So we could see 783 on the 10-year benchmark rates coming through. I think a lot for the bond market particularly, which is facing a bit of a short-term supply-demand mismatch, the FPI limits will be critical.
Okay. Sajjid, the fact that the Fed did not raise rates, and there's a possibility that they may not even raise rates in December. In that case, do you think there's a bit more leeway for Raghuram Rajan to maybe give the market a bit more of a booster in terms of maybe an outside chance of a 50 basis point rate cut?
I don't think a 25 or a 50 basis point will depend on the Fed. I think in a way, the Fed's actions matter much more for other emerging markets. India has been relatively insulated from Fed actions because of the fact that we've got, the current account deficits collapsed, the BOP is going to be in surplus, reserves have picked up. So I think interest rate policy will be driven much more by inflation dynamics. I think the RBI's first task is to ensure in this new regime that the 6% target and keeping inflation below in the 4 to 6% band over the next 2 years is met. I think that will guide policy. I think the other reason you need to be cautious is, let's not forget that this is the first time since 1985 that we've had 2 back-to-back droughts. Now, I think the good food management by the government, lower MSPs, global food prices being benign on help, keeping food inflation contained for now. But you'd want to be cautious going forward and want to be sure that food prices don't spike in the coming months on the back of these 2 droughts. I think it's those reasons and where inflation will be 3 or 6 months or 12 months from now that will drive today's policy more than the Fed action, just given how comfortable we are in the external sector.
Okay. Taimur, just taking that point forward which Sajjid mentioned, do you think that the RBI would just wait it out, see the CPI figure for September after the base impact is not existent anymore, and then assess what the food inflation trajectory might be, what the impact of the deficient monsoon is, and hence be in a more comfortable position to hike rates maybe in the next policy or even off market, and hence hold this time?
No, I think given the guidance that we have seen in the last few months, I don't think the RBI is being ultra cautious. I mean, today, holding on the basis of the factors that you just mentioned would show them to be ultra cautious. And, we all know they have quite a bit of pressure on them also to take advantage of the fact that WPI, CPI are on a fairly benign territory. I don't think from a cost-benefit point of view, cutting today, the cost is that potentially high if indeed food prices surprise down the road. They can just basically then be on a perma-hold mode. I don't think there is any scenario for hiking rates anymore for years to come.
Okay, just about 50 seconds left for the decision from the RBI, 45 seconds to be precise. So let's just take a look at what the market is doing. First, the bond market. That's, I think, the most important parameter to watch in today's trade. For 773 is the yield right now. It's been one market in